Hi there, it's Friday the 20th of March 2020. I'm Steve Towers. Welcome to ITB. Let's get started. Many governments continue to respond to the economic crisis caused by COVID-19 by announcing significant economic support packages for individuals and businesses. As I noted in last week's ITB, the support packages generally involve a deferral of income tax and/or VAT payments for both individuals and companies, and sometimes a reduction in certain VAT rates. And this week, a number of countries have announced or suggested substantive tax law changes impacting companies. For example, China has announced an increase in the rate of VAT rebate on exports of about 1,500 items. Norway has announced the carryback of tax losses by companies for 2 years and has also announced a reduction in its lower VAT rate from 12% to 8%. New Zealand has announced the reintroduction of tax depreciation on commercial and industrial buildings and an increase in the ceiling for immediate deduction of the purchase price of low-value assets. Indonesia has announced that the income tax rate for companies operating in 19 specific sectors will be reduced by 30%. Japan is considering a reduction in its standard rate for consumption tax from 10% to 5%. And in the US, Senate Republicans are proposing a law change which would enable a company's net operating loss to fully offset taxable income instead of the current 80% cap. Meanwhile, a number of countries have tried to ease some of the tax difficulties which might arise from prohibitions on travel. For example, it's been reported that the governments of France, Belgium, Luxembourg and Switzerland have agreed to relax the time limitations which apply to cross-border workers. And in Australia, the tax authorities have announced that the forced presence of directors or employees in Australia due to COVID-19 will not be used in regard to assessing either the resident status or the PE status of a foreign incorporated company. The European Commission has announced that the EU will have a state aid temporary framework, which will enable member states to support their economies during the COVID-19 outbreak without breaching EU state aid rules. The Commission has issued 2 press releases on this matter. The first concerns the EU's general response to COVID-19, and the second is specifically on the state aid temporary framework. For a copy of both press releases, please go to our website or app. And you'll be relieved to know that the OECD's work on the digitalisation project continues full steam, with meetings being held remotely. For a copy of the OECD's notice, please go to our website or app. In Australia, the full federal court has decided a case in regard to losses incurred by a taxpayer on speculative share transactions. Although the taxpayer is an individual, the principles in the case should equally apply to companies. The taxpayer was not a share trader or dealer in the sense that his share investments were not held as inventory. However, he did acquire shares in a commercial and systematic way for the purpose of deriving a profit on sale. Unfortunately for him, the shares plummeted in value and he sold them for a significant loss. The court concluded that based on the so-called Meyer principle, the shares were revenue assets of the taxpayer. If he had made a profit, the profit would have been ordinary income, not capital gain. But as he made a loss, the loss was an ordinary deduction, not a capital loss. For a copy of this case, please go to our website or app. In India, the government has deferred the introduction of mandatory electronic invoices for GST purposes from the 1st of April 2020 to the 1st of October 2020. Commentators have said that this deferral is no surprise in light of the inadequate testing of the government's IT systems. In Taiwan, the tax authorities have issued a notice in regard to offshore e-commerce suppliers which have not yet commenced issuing so-called cloud invoices in B2C transactions, despite the fact that the obligation to do so has existed since the 1st of January this year. The notice states that the penalty-free period has expired and that failure to issue cloud invoices in the future will be penalised. For a copy of this notice, please go to our website or app. In Thailand, the tax authorities have announced a tax incentive for companies which participate in the voluntary greenhouse gas emission reduction project. The tax incentive is an exemption from corporate income tax for 3 consecutive years for profits arising from the project. For a copy of the announcement, please go to our website or app. And also in Thailand, the tax authorities have announced a 10% income tax rate for companies operating in special economic zones. The announcement indicates that this incentive rate will be aligned with tax incentives which are granted by other government agencies, notably the Board of Investment. For a copy of this announcement, please go to our website or app. In Denmark, the High Court of Eastern Denmark has decided a transfer pricing case in regard to the application of the transactional net margin method. The case concerns whether the operating profit of the Danish taxpayer should be adjusted by excluding goodwill amortization. The Danish taxpayer was a distributor of pharmaceutical products. The goodwill had arisen from a merger transaction which had occurred several years before the relevant years in the case. The Danish taxpayer argued that the goodwill amortization had no relevance to its current operating profitability and should therefore be excluded. The OECD transfer pricing guidelines do not mandate that goodwill amortization expenses should be excluded. However, they do say that exceptional and extraordinary items of a non-recurring nature should be excluded, and that difficult comparability issues can arise if the accounting treatment of several items, including amortization, by third-party comparables is unclear. That last point was relevant in this case. According to the court, the Danish taxpayer failed to establish that the comparables possess goodwill which was not capitalised in their financial statements and which corresponded to the value of the Danish taxpayer's goodwill. Therefore, said the court, the goodwill amortization could not be excluded on the basis of a comparability adjustment. For a copy of this case, please go to our website or app. An Advocate General for the European Court of Justice has issued an opinion in regard to the VAT treatment of a supply of management services. The case concerns the question of how to treat a single supply of services which relate to both taxable and exempt uses. The taxpayer is a UK company in the BlackRock Group. It receives services from a related US company. The UK taxpayer uses those services to manage special investment funds, SIFs, and other funds. Management services for SIFs are exempt from VAT, whereas management services for other funds are taxable for VAT purposes. The services supplied by the US company to the UK taxpayer cause the UK taxpayer to have a liability to pay VAT under the reverse charge mechanism. The issue in the case was whether those services supplied by the US company to the UK taxpayer should be treated as partially exempt and partially taxable by apportionment based on the relative value of the management services provided by the UK taxpayer to the two types of funds. In the Advocate General's opinion, treatment of the single supply of services by the US company to the UK taxpayer cannot be partially exempt and partially taxable. Instead, the whole amount should be treated as taxable. But the opinion does give this qualification. Nevertheless, I wish to stress that in circumstances other than those presented to the court in the present case, exemption could possibly be granted to services provided by a third party to a fund manager, provided that the supplier of the services provides detailed data which enable the tax authority to identify precisely and objectively the services provided specifically for SIFs. In that event, the services provided solely for SIFs may be exempt, provided that the supplier of the fund management services or the recipient of those services in the case of a reverse charge is able to provide the tax authority with those data, which would have the effect for tax purposes of treating similar situations objectively. Since such data are lacking in the present case, no such case arises and the exemption cannot be granted. As you know, the opinions of Advocates General are persuasive but not binding on the court. For a copy of this particular opinion, please go to our website or app. In France, the Supreme Administrative Court has decided a case in regard to the level of penalty imposed on a company for breaching a tax rule. The issue in the case was whether the level of penalty was so high that it breached the European Convention on Human Rights. The particular penalty was imposed on a company for non-compliance with a tax law condition to retain ownership of a building for at least 5 years. The penalty was 25% of the value of the building. The company argued that the size of the penalty breached Article 1 of the first protocol of the Convention, which is set out here. I won't read it out. Please hit the pause button to study it. The court decided that the size of the penalty was disproportionate to the seriousness of the non-compliance. It therefore held that the penalty breached Article 1. For a copy of this case, please go to our website or app. In Germany, the government has issued guidance in regard to so-called compensation payments which are made by subsidiaries within a tax consolidated group to minority shareholders. In particular, the guidance describes the conditions for compensation payments which include a variable component to not impact the existence of the tax consolidated group. For a copy of this guidance, please go to our website or app. In Norway, the Tax Appeals Board has decided a case in regard to whether an input tax credit can be obtained by a Norwegian company for VAT on legal fees which were incurred in acquiring 100% of the shares in two other Norwegian companies. The taxpayer company carries on a business of developing and licensing software and providing related consulting services. The two new subsidiary companies each carries on a similar business. All three companies are VAT registered, and all of their supplies are VAT taxable. Nevertheless, the board held that the taxpayer company was not entitled to an input tax credit. For a copy of this decision, please go to our website or app. In Spain, the Central Economic Administrative Court has decided a VAT case in regard to the provision of services by an Irish head office to its branch in Spain. Most of the services originated from a related company in Switzerland. Importantly, the Irish head office and the Spanish branch carried on insurance activities. The issue in the case was whether the services provided by the Irish head office to the Spanish branch were subject to Spanish VAT. The court held that the services were indeed subject to Spanish VAT for three reasons. The first reason is that the branch was considered to be independent of the Irish head office. The situation therefore falls within a possible exception identified by the European Court of Justice in the FCE Bank case. The second reason is that the branch belongs to a VAT group in Spain, and therefore the service transaction should be understood as being between the Irish company and the VAT group as a single taxable entity, in accordance with the decision of the ECJ in the Scandia case. And the third reason is that most of the services should be understood as being supplied by the related company in Switzerland directly to the Spanish branch. Commentators in Spain have criticised this decision, particularly the first two reasons. For a copy of the decision, please go to our website or app. In Sweden, the government has released for public consultation a draft bill which would introduce measures against non-cooperative tax jurisdictions based on EU recommendations. The proposed effective date is the 1st of January 2021. Public comments are requested by the 15th of May. For a copy of the consultation material, please go to our website or app. In Switzerland, the Zurich Administrative Court has decided a transfer pricing case in regard to a fund management structure. Two experienced individuals, both resident in Switzerland, formed two companies, a Swiss company and a Jersey company. Together, they held 100% of the shares in each of the two companies. The Jersey company entered into an investment management agreement with a Jersey private equity fund, and the Swiss company entered into an investment advisory agreement with the Jersey company. Both of the experienced individuals were employees of the Swiss company. The evidence showed that they took all significant decisions in regard to the investment management of the Jersey fund, although the investment advisory agreement stated that the Swiss company would merely provide recommendations for the Jersey company, which would evaluate the recommendations and make a final decision. The Jersey company had no employees other than two part-time directors. The fees paid by the Jersey fund were split between the Jersey company and the Swiss company on a 1/3, 2/3 basis. The Swiss company had prepared a transfer pricing report which showed that the net profit derived by the Jersey company was within an arm's length range based on benchmarking. The Swiss tax authorities rejected the 1/3, 2/3 fee split on the basis that, in substance, all the significant decisions were taken by the two employees of the Swiss company. Instead, it determined that the arm's length pricing would involve the Jersey company being remunerated on a cost plus 10% basis, with the remainder of the fee income being derived by the Swiss company. And the court agreed with the tax authorities. For a copy of this case, please go to our website or app. In the UK, the government has introduced into Parliament its 2020 Finance Bill, which includes the proposed Digital Services Tax. For a copy of the bill and its explanatory notes, please go to our website or app. And also in the UK, the government has released a number of consultation documents, including, in particular, a consultation document on the UK's hybrid and other mismatches regime, which addresses the issue of whether the existing rules are too widely drawn, and a consultation document on the proposal to require large businesses to notify the tax authorities of uncertain tax treatment. For a copy of both consultation documents, please go to our website or app. And finally, in the UK, the tax authorities have issued for public comment draft guidance on the taxation impacts from the withdrawal of LIBOR as a benchmark interest rate. Public comments are requested by the 28th of May. For a copy of the draft guidance, please go to our website or app. In South Africa, the tax authorities have issued updated guidance on capital gains tax for companies. For a copy of the updated guidance, please go to our website or app. And also in South Africa, the tax authorities have released draft guidance on royalty withholding tax. For a copy of the draft guidance, please go to our website or app. And in the US, there are more developments in the Altera transfer pricing case concerning employee stock option costs. Two more significant briefs supporting Altera's appeal to the Supreme Court have been filed, one by a group of 25 multinationals and the other by 3 of the Big Four accounting firms. For a copy of the two briefs, please go to our website or app. I have 2 articles for you this week. The first article is called Global Crises and Loss Planning. It's written by Mindy Hersfeld and it's published in Tax Notes Today International. This article describes the major corporate tax relief measures which the US government took in the wake of the 2008 financial crisis, and it considers whether the 2017 US tax reform legislation has made it more difficult for the US government to respond in a similar way to the current COVID-19 economic downturn. The author writes this: the 2017 US tax reform's modifications to the code have made the type of temporary measures introduced in response to the 2008 financial crisis less viable. In many cases, they seem likely to exacerbate the effects of any financial downturn. And the second document is an IBFD white paper called The Role of Foreign Court Decisions Towards Global Convergence in the Interpretation of Tax Treaties. The white paper contains 2 articles which together won first prize in the IBFD's inaugural GTTC Universities project in 2017. One article addresses the topic from a South African viewpoint, and the other article addresses the topic from a Canadian viewpoint. Both articles contain a useful summary of foreign cases on double tax treaty interpretation, which have been cited by national courts. However, the conclusions reached in the 2 articles are somewhat different. The South African article concludes in this way. It appears that the South African courts are prepared to consider cases from a variety of global sources and on a number of issues, making a strong argument for convergence of the South African legal system and global case law, and, to borrow the phrase from Osteem quoted in both Downing and ITC 1544, the existence of an international tax language. Whereas the Canadian article says this: the author's research does not provide evidence that Canadian courts are participating in the global convergence in the interpretation of tax treaties through the use of foreign decisions. Of all Canadian decisions surveyed and examined, only a small fraction referred to foreign decisions. Only 2.2% of database entries surveyed lent relevance to a foreign decision. Well, that's the way it is this Friday, the 20th of March, 2020. I'm Steve Towers. Have a great weekend.